I think maybe just one comment on the opportunistic thing as well is that often those deals are being funded in debt, but it's hidden debt in the sense of a credit facility line that's secured against the equity, so that facilitates those deals as well quite a lot. But at a general level, I think depends on which end of the telescope you're looking from, because you're right, we're both, given our different platforms, we're both an equity investor looking for substantial amounts of debt on the acquisitions we undertake, and we're also an investor in debt or providing debt finance through our debt platform. So we do see it from both ends of the spectrum.
Do you lend yourself money, Rob?
We don't do that, no. That's the one thing we won't do. But it's, for me, there's been a massive shift since the end of last year, and from an investment perspective, we bid on for example, the Eurohypo UK loan portfolio, which was sold recently, obviously, to Wells Fargo and Lone Star. We bid on that transaction, and it was the first signs for me post last summer of the massive liquidity that was building in the US market, both balance sheet and CMBS, and that's flowing back into the European market as well. So that, I think, was one of the strongest early signs of the liquidity changing. We're looking at a very large core transaction in Germany. We're looking at another one in France at the moment, and we're looking at asking for 55, even up to 60% LTV on a core deal, and we're being offered margins of 150 without negotiating them. So, you know, there has been a very major shift in liquidity in the market. You know, at the moment, if it's a core deal, as the others said, there's no shortage of debt. I'd be a little bit more positive even than Ignace was on sort of core plus and the value add. I think what makes a big difference there is who the sponsor is. So the asset obviously might have some risk, but if there's a sponsor behind it that the banks feel comfortable with, then certainly debt is also available, obviously more expensively, but it's still hugely accretive. I mean, swap rates are still, you know, 1.5%, 1.6% on a 5-year basis. You know, with a margin even of 250, 300, 400, you're substantially in the money. So I wouldn't say it's back to the good old days. The biggest difference obviously remains the level of leverage. So the cost of finance is significantly down, but the amount of leverage in terms of LTV is still lower than it was, and I think that will remain.
And where's that at the moment? Kind of 50%, 60%, or?
On a senior basis, up to 60, maybe you can push it to 65 for the very secure. And then above that, you've clearly got quite a lot of mezzanine providers who are trying to do the 65 to 80 tranche, and that's still at about 1,000 basis points over on most transactions, so that's quite expensive debt. I think one of the things that will emerge more is the whole loan provider. So those who will actually write the whole thing between 0 to 70, 0 to 80 maybe, and they'll be able to refinance the 0 to 50 piece out into the market very attractively, and I think that's what's going to change. But those are the kind of ranges.